Welcome back, everyone. We have an exciting episode to get into. In this one, we're going to be doing something that we've done in the past, which is to rank stocks on a literal tier ranking list. So we have S tier, which is the very best, the absolute best. Then we have A tier, just a step below it, but still good. Then B tier, which is middle of the road. C tier, that's not good. And F tier, which is horrible. Dumpster fire, complete failure. And then we have the stocks that we're going to be ranking. You can see the two rows there. We have Google, Intel, MasterCard, Nvidia, S&P Global, PayPal, Apple, Salesforce, Amazon, Microsoft, Tesla, Disney, Canadian Pacific, the railroad, and then Netflix. A lot of these companies I own, some of them I don't own, but I'm going to try to rank them fairly. And the criteria that I'm ranking these companies on is going to be the cash flows of the company, the free cash flow profile of the company. So I'll factor in a few different things. First of all, the yield, so the valuation. What is the trailing yield of the free cash flows of these companies? And then we look at the amount of dilution they do through stock-based compensation. We're going to be factoring that into the analysis. And then I'll also be factoring in the growth rate and consistency of free cash flow. So we have the starting yield valuation, we have the dilution through stock-based comp, and we have the consistency of growth. And through that, we can form what I believe is a pretty good overall free cash flow profile of a company. And the way that I'm ranking them is simply best to worst. So the best companies will have very attractive starting yields, they'll have fast growing cash flows, and they'll have low amounts of dilution through stock-based compensation. That would be the ideal company. The worst one is just the opposite. A company that has a very low starting yield, a company that has very unpredictable cash flows, and a company that does a lot of dilution. So having said that, let's go ahead and start right off. The first one we have here is Google. And like I said, many of these companies are in my portfolio. Google's one that I own. So let's go ahead and just take a look at Google here. We'll pull it up on Qualtrim Insights. We can search for Google here. And if you're not familiar, this is a website that's included as part of my Patreon membership. It's $10 a month. It comes with a free 1-month trial, so you can try that out. But let me blow it up here. I'll zoom in so you can see the main item. We have Google here. This company, if we scroll down, we get to the valuation metrics. And right here, we have the main one that we're ranking them on today, the cash flows of the company. I added in this new summary item here, this new feature into Qualtrim. And what it does is it calculates three different things. One of them is the starting free cash flow yield of the company, which is simply the trailing 12 months cash flow divided by the market cap. Very simple. And for Google, that's 3.86%. But remember that the simple calculation, the traditional one for free cash flow, leaves out the dilution through stock-based compensation, which for some companies, like Google, has a pretty sizable impact. I can show you visually right here the impact this has. Here's the free cash flows in orange, and then we have the stock-based compensation in purple. So you can see that it's eating up around 30% of the free cash flows. Well, I actually calculate that, and that's how we get the stock-based compensation impact. It's minus 32%. So the actual free cash flow yield adjusted for stock-based compensation is 2.6%. So is this an amazing starting yield? I don't think so. I think it's good. It's a healthy yield, especially for a company like Google that's proven itself, that has a strong balance sheet, that has a great moat. I think this is a decent yield. But the fact that so much of the actual free cash flows get diluted away makes it so that it goes from a 3.86 to a 2.6. That makes the overall starting yield less attractive. So in terms of starting valuation, I think it's good, but not amazing. Now let's go ahead and take a look at the free cash flow growth profile of the company. How much has it grown over time? Over the past 5 years, it's grown at 20%, which is in an elite category. Growing that fast is very, very impressive. When we look at free cash flow per share, that's 21%. So they're doing some buybacks. When we adjust that for stock-based compensation, the same thing. They've grown their free cash flows at 21%, even when you factor in stock-based comp, which means that they're simply growing their free cash flows at around the same rate of their stock-based compensation. So overall, when I look at this, the big thing that strikes me as a major demerit for Google, the only downside in their cash flow profile, is the stock-based comp, this dilution. It really has a huge impact. Wiping away 32% of the free cash flows every year is a major thing. If Google got this under control and was able to actually take this down or at least keep it flat while growing the company, that would be a major catalyst for value creation for the investor. And just on a side note, this is something that Warren Buffett has repeatedly said that he hates. He does not like dilution. He does not like companies that give out stock like candy. In fact, if you look at Berkshire, for example, here, if we bring this one up, Berkshire has no stock-based compensation impact, 0%. They have literally 0% SBC because Buffett hates it so much. So looking at Google, I think overall the company's good, attractively valued, not amazing, but the stock-based compensation is a major thing that I give as a downside for it. So I'd put this one in the A category. I'm actually not going to put it in the S category because I don't consider it the perfect free cash flow profile. Next up, we have Intel. This is a company that last time I looked over this company, I thought that it was a disaster. I think things were going very poorly for Intel. Let's see if things have improved at all. Forgot a C there, INTC. Okay. Here we have Intel. A note that it's trading higher today. That's good to see. We bring up Intel here, and we'll switch over to quarterly so we get the latest quarters in. But if we look at the free cash flow yield, minus 27%. Is that right? That seems not right. It might be. I've doubled and tripled and quadrupled checked the calculations on Qualtrim. I think it's usually correct, but minus 27%, maybe it has heavily negative free cash flows in the past 4 quarters. And then the stock-based compensation is minus 30%, so it actually doesn't have a huge impact from SBC. But overall, it looks like they've had a rough trailing year. Let's go ahead and take a look. All right, it does actually look like that's correct. If we look at the last year, the free cash flows have gone from the positive into the negative here. And it looks like last quarter, they're doing minus 9 billion, minus 4 billion, minus 11 billion. These are pretty negative free cash flows. So it does look like Intel's still struggling right now. Now, obviously, this is trailing metrics, so Intel is they're going to eventually generate positive free cash flow again. I do fully believe that. They will turn it around. They're doing major investments right now, and they have their competition cut out for them. But right now, this still looks completely atrocious. Across the board, it looks bad. And in terms of growth, even if we erase the past year, if I was to just ignore this entire past year, the growth profile doesn't really look that good over the past couple of decades. Intel has the same amount of free cash flow in 2021 that they did all the way back in 1999, all the way back in 2004, the same in 2011. It's roughly around the same amount. So I don't see any growth in cash flows over virtually a 20 to 30 year period. It's basically stagnant. And this is at a time where their industry is growing. So Intel is just losing market share and struggling to keep up with the industry growth. I think this one's atrocious. I put Intel in the F category right now. Now, next up, we have MasterCard, one of the payment processors, a duopoly with Visa. And this is one that I own in my passive income portfolio. And let me just give you a little bit of a spoiler alert. If it's in my passive income portfolio, the free cash flow profile is going to be pretty good. I screen for this type of thing more than any other type of thing. So when you're looking at any company in the passive income portfolio, any of my core positions, they're going to have, I think, personally, exceptionally good free cash flow profiles. Now we look at this one. We have MasterCard brought up here. The starting free cash flow yield is only 2.85%. So it's lower than Google's 3.9%. But the thing with MasterCard, and the same thing with Visa, is that even though they have a little bit lower starting yield than a company like Google, they have almost no stock-based compensation impact. It's only minus 3%. So their actual free cash flow yield, the stock-based compensation adjusted free cash flow yield, is almost identical to their starting free cash flow yield. The adjustment makes almost no difference. It goes from 2.85% to 2.75%, 0.1% difference. So when I compare this again to something like Google, we can bring that up here again. Just to draw the comparison, Google has a higher starting free cash flow yield, but the actual diluted free cash flow yield is lower than MasterCard's. meaning that Google, on a free cash flow basis, is trading at a higher price than MasterCard. And that's something that I don't think a lot of investors look at, because most of them, again, they're mostly looking at just the starting yield. They're not factoring in the dilution. So here we have a free cash flow adjusted yield of 2.75%. And then we look at the profile overall. What does the growth of free cash flows of this company look like? I can bring that up here. In the past 5 years, it's grown at 14.5%, which is pretty good. We look at it with stock-based comp. We know what it looks like. Not much there. And then we look at the adjusted free cash flow per share growth. This is actually higher at 16.87%. So not at that 20% level, but still the high teens. That's very, very fast. Another thing I'd mention is the consistency of free cash flow. It ebbs and flows a little bit, but it's overall incredibly, incredibly consistent. When I look at MasterCard, I think this company is elite in the way that it's able to generate cash flows and the way that it's able to grow its cash flows on a consistent basis. Moreover, I think that the valuation is not that demanding, trading at a real adjusted free cash flow yield that's even more attractive right now than Google. So I put MasterCard currently as S tier. Next up, we have Nvidia. This one has a lot of chatter, so let's go ahead and dive into it. The first thing that I'll say with Nvidia is I do not own this company, and I've been cautious about the valuation. You know me, I'm not someone that's afraid to buy companies that are a little bit more expensive if I think they're quality companies that are long-term compounders. So I'm not someone always looking for the cheapest company. I'm not a dumpster diving for the cigarette butts. That's not my style. But when I look at Nvidia, they're very, very low. The free cash flow yield, even before stock-based comp, is 0.5%. So half a percentage, barely in the positive. Then you have stock-based comp that brings it down to 0.24%. So the stock-based compensation eats up around 56% of the trailing 12 months of free cash flow. Now, they just reported their last quarter, and a lot changed over that quarter. What Nvidia did was give incredible guidance. They basically said that all of the spend in AI is going to them. They're just like a big sponge absorbing all of the spend in AI. So they actually had a great quarter. They generated $2.66 billion in free cash flow. And then they actually guided way up in this next quarter. So a very impressive quarter by Nvidia. I was genuinely shocked. I've never seen a quarter like that from a company this large. We look at the growth of this company. It's grown its free cash flow by 15% over the past 5 years. That's in a very high category, right there with MasterCard, right underneath Google. Then they're guiding up for even more growth. So very good growth. They certainly have the growth aspect. We look at the stock-based compensation. I think this is a major demerit. This is not like MasterCard where it's only a sliver of their total free cash flows. They have to hire so many engineers and people to build these chips and to develop them and everything like that. So they have a lot of expensive talent that they have to constantly retain and keep from competitors like AMD and Intel. To do that, they have to do a lot of dilution to pay those employees. So they have that problem, which I think is a little bit of a demerit. When I look at the adjusted free cash flow per share, this is also growing very steadily over time. Great growth profile. The big things that I have a concern with Nvidia is the yield right now and what's implied in the price going forward. This is a stock that has exceedingly high expectations already priced into it. It's in a market that I'm not an expert in this market, but from what I can tell, there is competition in the market. There's lots of big tech companies making their own chips, and there's other competitors like Intel and AMD that are trying to do very similar things to Nvidia. Right now, they're the market leader. They're consolidating. They're doing great. But I think there's a great deal of risk in this company. I think that investors investing in Nvidia right now, I think they're playing with fire. But when I judge the free cash flows of Nvidia, I'm going to give this one a B. But the reason I'm ranking this one down is because of two reasons. The starting yield is incredibly demanding, and they do a lot of dilution through stock-based comp. Those are two unattractive qualities in a stock. Next up, we have S&P Global. This is another one that's in the passive income portfolio. This is one that I bought in earlier this year. The ticker symbol is SPGI. Starting yield of 2.5%. Not bad. It's a more expensive company. You can certainly find cheaper ones, but this is a very wide moat, predictable company that's heavily diversified. So I consider this to be a decent starting yield. And like MasterCard, This company has incredibly low stock-based compensation impact, less than 6%, meaning that the starting free cash flow yield is almost identical to the stock-based compensation adjusted free cash flow yield. That is only 2.33%. So it's a more expensive company, but it doesn't have to worry too much about dilution. Now, judging the free cash flow growth over time, this company is a compounder. When I look at just the total free cash flow, since around 2010, it's been growing steadily. They've been diversifying their business. They had a down year from 2020 to 2021. That is the credit rating business and some cyclicality in that business. But even with that, they've grown their free cash flows over the past decade by 15%, which is in that elite category. Not many companies can do that. So in my opinion, this one's very good. I put it S tier. Again, I'm biased. I buy the companies that I think are S tier for this very reason. But S&P Global has a very wide moat, consistent free cash flows, grown it over a decade, and has almost no stock-based comp. Attractive qualities across the board. Now, after S&P Global, we have PayPal. This one's shown up on the radar of a lot of value investors and different investors because the company sold down dramatically from its euphoric highs. We have the chart right here. And you can see that for a time period where payment processors and fintech were taking over the world. Remember that whole narrative? Payment processors, fintech, there's no price too high. Yeah, that's what caused PayPal to go up hundreds and hundreds of percentages. And then the narrative changed, the story fizzled out, and PayPal's back to where it was 25% below 5 years ago. So this one's been brutal for any investor that's been buying it recently. But we look at it now based on the current valuation and what we think is going to happen. And right now, PayPal has, out of every company we've looked at, by far the highest starting free cash flow yield, 7.48%. That's just high. 7.48% is a high free cash flow yield for any company, including oil, including financials. It's just a very high yield. This company does not trade at a very demanding valuation. Now, we adjust out stock-based compensation, and even though that's an impact of 23%, still very attractive. It brings it down to a 5.74%. 5.74%, factoring in stock-based compensation, is so far the lowest valuation of any company we've looked at. And in my opinion, right off the bat there, it doesn't imply a huge hurdle for PayPal to overcome. This company doesn't need to do much to justify the current valuation. So let's go ahead and take a look at why investors are bidding this company down. We'll try to figure that out. When we look at it right now, the free cash flow growth actually looks decent over the past decade, 17%. That's in the category of pretty good companies. The only criticism that I'd launch here is that it seems like they took a breather since 2018. Notice how it went up to around $5 billion in 2018, and then it just kind of stayed there. Typically, you want the companies to continue growing their free cash flows, but it just took a breather there. We have some good and bad here. When I look at PayPal, I don't think it's the worst bet in the market. I don't blame investors for buying this company. The valuation is undemanding. Not everything has to go perfectly for this company to be a good bet, to be a good, predictable bet. The only thing that strikes me as a major concern when I'm looking at this one is a company called Apple. Every checkout that I go to now has different options, and one of them is Apple Pay. If I'm going to choose between PayPal checkout and Apple Pay, I'm going to be using Apple Pay every single time. And what I see is lots of reports that Apple Pay is growing rapidly. So I think that's part of the reason that the company trades at such an attractive valuation. But even so, I have to give PayPal credit. The valuation's not demanding. The company does have growth over the past 10 years. There is some stock-based compensation, but because the valuation is so low, I give this one an A. After PayPal, we have Apple. Now we look at the current yield, it's 3.5%. That's not bad. The stock-based compensation impact is only 10%. So the adjusted free cash flow yield is 3.15%. Not bad. A funny thing about this is a lot of people, they look at the PE ratio and they see that Google's trading at a lower PE. But when you actually look at the free cash flows, Apple is a cheaper company than Google based on their dilution adjusted or stock-based compensation adjusted free cash flow yield. Apple's cheaper. So the company actually has not too bad of a starting yield. Now, the amazing thing about Apple is the growth that it's had over the past decade and the past 5 years. Over the past 5 years, in fact, since around 2017, the free cash flows went from $50 billion per year to now 111 billion per year. So it's doubled over a 5 or 6 year period. When Warren Buffett was buying Apple back in this time period, the company had around a $500 billion market cap. So it had a $500 billion market cap. And if you look at it now, it's doing $111 billion in free cash flow, meaning the price that Warren Buffett paid for Apple, Apple could buy the company's entire market cap with 5 years of their current free cash flow. That's what he paid for it. So he got an absolute steal buying this company back in 2017. The free cash flows have gone up at a phenomenal rate. When you factor in stock-based compensation and you look at the free cash flow per share growth, it's much, much faster. Because Apple's used all of that cash flow not to do silly acquisitions, but instead they've used that to buy back shares. So their free cash flow per share growth over the past 5 years is 24%, beating out Google, beating out MasterCard, beating out S&P Global, beating out every single company that we've looked at so far. Faster free cash flow per share growth than all of them. Apple has been a phenomenal company. And still, even today, it trades at a lower valuation than almost all of its peers. So when we look at Apple, does it have the growth? Yes, it does. It's proven that it's able to grow cash flows much above investors' expectations. Does it have a lower starting yield? Yes, it does. And does it have a very low stock-based compensation impact? Yes, it does. It checks all three boxes. I believe this company's in the elite category of an S tier. Now, after Apple, we have another company that I actually own in my Story Fund portfolio that I recently took some gains out of, which is Salesforce. Now, let's go ahead and take a look at this one. This one's very, very different than Apple. We have a starting free cash flow yield of around 3%. We'll just round that to 3%. Doesn't look too bad. The big problem with Salesforce, as I've highlighted, is that their stock-based compensation impact of those cash flows is 52%. That's not a miscalculation. That's not a typo. The free cash flow yield, your actual cash flows, goes from 3% to 1.4%. Cut in over half because of the amount of dilution they do. You can look at this and it's incredible. Let's go ahead and take a look here. I flip over to the free cash flow. This is what most investors are looking at. It just looks beautiful. But then I flip over with stock-based compensation and you see the problem there. They hire so many employees. They pay them with such big stock-based compensation packages. It really eats into the actual cash flows you're getting. When we adjust this out, the growth actually looks good. You can see we have a very steady growth line here. It's grown 13% free cash flow per share over the past 5 years. But the big problem here is the starting yield of the company. So when I look at Salesforce, incredibly low starting free cash flow yield, high amounts of stock-based compensation dilution, that gives this company, I think, around, I'd say B tier. Not the worst. I think it's still good because it does generate a lot of growth, but those two different aspects, that level of dilution and the fact that it has such a low starting yield, I think knocks it down to a B. And that's, again, part of the reason I sold the majority of my position recently in Salesforce and put it into other companies. Now we have Amazon here. This one is one where I'm breaking some of my own rules here. Amazon's numbers right now look atrocious, especially on a trailing basis. They just look horrible. We have a free cash flow yield of minus 0.7%, so in the negative. We have a stock-based compensation adjusted free cash flow yield of minus 2.4%. So negative 2.4%. The stock-based compensation impact is 246%. That is accurate. So it's really horrible. Across the board, horrible. When I look at this unbiasedly, I think in terms of current free cash flow profiles, Amazon has its F tier. It's right there with Intel. If you're just looking at it currently, it looks really bad. The reason that I have a major investment in Amazon is I think that this is going to change. I think a couple of years from now, I'll be able to move this from here up into this category. That's the investment thesis. If that doesn't happen, then I'm going to lose money on the stock. If they just continue to do what they're doing, burning so much cash, spending so much money on stock-based comp, never able to generate a profit, it's going to be a failed investment. But the goal here and my thoughts is that this is going to change. Now we have Microsoft here. But if we look at the valuation, it's trading at a pretty high valuation, a low free cash flow yield. 2.33%, even without stock-based comp. That's a very low valuation. We look at the adjusted free cash flow yield, 1.96%. So this company's really gone on a run over the past couple of months. Take a look at this. We look at 1 month here, it's up 7%. 3 months, it's up 30%. Year to date, up 37%. So that's really, it's put the free cash flow yields down. It's brought the valuation up. I went from being in the red on Microsoft by 5,000 to now being in the green by around 9,000. So this company's it's really turned around its stock price. And the stock-based compensation's a minor impact for a company like this, minus 16%. It has good growth. Microsoft has grown its free cash flow tremendously over the past decade with their transition to SaaS and cloud computing away from legacy desktop installation. The stock-based compensation, I also think, is relatively under control for Microsoft. I do not think it's a problem. I'd give this one, I'd give it an A. It's not as bad as Nvidia or Salesforce. It's not as good as MasterCard or Apple. I think it's right here with PayPal, Google, and yeah, we have Microsoft right there. Next up, we have Tesla. Let's go ahead and jump into this. Tesla here. I haven't looked at Tesla in a while. I don't look at this company too much because I thought that I'm not really going to invest in it, at least not right now. To me, I just don't have it proven to me that it's not a car company. And I know a lot of people go crazy when I say that, but they sell cars. That's where they make their money. And there is competition in what they're doing. I realize that they have huge advancements and they have a moat in their manufacturing and they have the full self-driving they're working on, but it's still mostly a car company right now. When they make the jump to more of a software, Apple-like ecosystem model, then I'll be more attracted to this stock. When I look at it right now, the numbers look a little low here in terms of valuation. So we have a free cash flow yield of less than 1%, 0.95%. We have stock-based compensation that impacts that around 27%. So that's actually a pretty decent impact. The stock-based compensation adjusted free cash flow yield over the trailing 12 months is 0.7%. It looks a little pricey based on the trailing 12 months. Now, if we look at the growth of the company and the consistency of free cash flow, I actually really like the profile here. I think this is a strong point for Tesla. When they're making major CapEx investments into their gigafactories and trying to build out production, the cash flows went negative. That's fine. These are very good investments that are getting a high return. And then you can see the cash flow swing positive on a very consistent basis, going up year after year after year. I really like this profile of growth. When we adjust for stock-based compensation and we put it on a per share basis, we also see tremendous growth. We have exponential growth from 2021 to 2022. So in terms of growth, Tesla has it. They have rapid exponential growth. But the downside is that a lot of that growth, a lot of it is already baked into the price. The company does have to continue to execute really well. It does have to continue to grow free cash flow to justify the 1% yield. Investors are at least expecting it to double or triple, even quadruple from here. So some of that's already baked into the price. In my opinion, I put this, I don't think it's the worst right now. I put it right now, I'd put it in the B category. I'd put it with Salesforce and Nvidia. I'd put it right there in the B category. And the big thing this time is because I'm factoring in current valuation. If Tesla was at a lower valuation and there is less already baked into the price, then I'd bump it up to an A or an S. But right now, with the valuation, there's already a lot priced in. We have Disney. Disney's a company that I held for a long period of time. It was one of my OG buys when I first started investing, because Disney creates fun things. At Disneyland, the movies, Star Wars, all the stuff that they're doing. But the company's evolved over time. They've made a lot of management decisions that I have not agreed with. They've had struggle growing streaming profitably, competing with Netflix and the other big tech companies, and their legacy business is in decline. So a lot of what Disney's doing is just a lot of moving parts and more complexity than I like. So I ended up selling out of that company. Now, if we look at the starting yield of the company right now, based on trailing metrics, it's very low. If you're investing in Disney, you have to know that the trailing year has been a very tough year for Disney, and they're now focused solely on profitability. So we should see ample improvement in their free cash flow over the upcoming 2 years. And this low starting yield of 0.86%, this should get a little bit better and more healthy as they actually generate cash flows. The stock-based compensation, it brings it from a 0.86% down to a 0.18%. So on a trailing metric, it eats up 80% of the free cash flows. because they're not generating much free cash flow to begin with over the trailing year. To give this a visual illustration, we can look at the history here. We look at Disney and the glory years of this company. The best years were from 2009 to 2018. Marvel, we had Star Wars, all their franchises were just mega hits. And at the time, there weren't as many competitors with their box office animated films as well. We have a lot more competition in animated media, and then we have them transitioning from what they're doing to streaming, which is costing a lot of money, sending their cash flows negative. An accumulation of factors making it so their free cash flow profile is going down, generating less and less free cash flows. And they just have not recovered this at the pace that I thought they would. I thought it would be a very quick bounce back. Has not been. It's taken a very long period of time. In terms of long-term growth, even zooming out further, it's also a company it reminds me a bit of Intel, where it's had around the same range of free cash flow for the past 2 to 3 decades, that $1 to $2 billion per quarter. It's good. It's a profitable company. But what we want are companies that are growing. Every single year they're growing and they're maintaining it. Consistency is a key thing. Overall, not a good picture. I think Walt Disney is struggling right now. I'd say that it's bad, but it's not the absolute worst. I'm putting this one in the C category. Now, next up, we have Canadian Pacific. This is another company in my passive income portfolio. This is a sector that I got interested in because I saw a lot of qualities that I thought were particularly attractive. One of them being the oligopoly nature of this industry. They only compete with really other railway companies. Trucking is the other competitor outside of their industry, and it's going to be very difficult for trucking to become more efficient than railroads. They have a long ways to go before they can do that. But one of the incredible things about these companies is the level of consistent profitability they have. Right now, Canadian Pacific has a free cash flow yield of 3.71%. They don't have any stock-based compensation, so the free cash flow yield adjusted for stock-based compensation is 3.71%. Very good, healthy, attractive starting yield for this company. Now, we look at the long-term history of it, and I'll put this annually to make it clear. You can see the growth this company actually has. It's actually remarkable how fast and how capable they are at consistently growing their free cash flow. Part of this is because of the unique, skilled management of Canadian Pacific. Incredibly good management. They've really turned around this company and made it a company that really wasn't all that attractive into one that's just churning out cash. And through another acquisition, they're expected to have a lot more scale and able to continue doing this. So it has growing free cash flow, growing 25% over the past 5 years, right up there with Apple, beating out a lot of big companies like MasterCard and others. Overall, I think this one is incredible. Very attractive, healthy starting yield, fast growth, consistent free cash flow, and no stock-based compensation. This is another one I put in the S tier category. And again, I'm biased here. I own these companies in the S tier category. But part of the reason I own them is because I think they're S tier. Again, this is a big part of my investments in the company. I'm investing in them because I think their free cash flow profiles are so good. And there's some that I own that right now, like Amazon, they're not S tier. Salesforce I own, not S tier. Google I own, not S tier, even Microsoft. But a lot of the ones I do, I think are very, very good. So last up, we have Netflix here. Let's go ahead and take a look at Netflix, see how this one's doing with the cash flows. This is a bit of not a turnaround story, but kind of a turnaround story. Netflix just a year ago or a couple of years ago was not generating free cash flows. You look at it and it just looked awful. And now the game has changed a little bit. They've really pulled those levers and have generated cash flows. On a trailing 12-month basis, the free cash flow yield is 1.8%. That's lower than Google, lower than Apple, lower than Microsoft, but it's not terrible. It's not in the Nvidia or Tesla category of being 1% or below. 1.8%, not too bad. The stock-based compensation is a 18.9% impact. That brings it down to a 1.45%. So it looks like it's a pretty high valuation, lower starting free cash flow yield, but we can go ahead and take a look at the growth in their cash flows here. When we look at this on a quarterly basis, this is what we see. Similar to Tesla, it had quarter after quarter and year after year of being in the red as they're making these big investments Tesla was doing them in gigafactories. Netflix was doing them in exclusive content, both building up things that they can leverage later. Now we have Netflix all of a sudden having that spike in positive free cash flow, massive growth, with the last quarter being $2.12 billion. This is an unusually high quarter, but they're even projecting to double their cash flows again this year. So the growth is there. They have very fast growth, even adjusting for stock-based compensation on a per share basis. They're now actually doing buybacks, so it's growing faster on a per share basis. Netflix has a lot of growth in their free cash flows, and they have a valuation that's a little bit demanding, not the lowest valuation, but also not in the extremes. It's not Nvidia category. I think right now I'd put this one right here in this bucket of companies. I think it's very similar. The growth is good. The stock-based compensation is under control, but the starting valuation is a bit more demanding than we would like. I'd like to get this one cheaper like it was a year ago. So that's it. That's the rating. And I think when I look over it, I got it right. I like the categories they're in. I think this mostly resembles what the free cash flow profile looks like with the valuation, with the level of dilution through stock-based comp, and the level of growth and consistency of growth. All those factored in is difficult to do, but I think we did a good job here. Let me know if you agree or disagree on any of these, and let me know companies you'd like to see included in this the next time I do this. That's all for now. If you want to talk over the weekend, make sure to check out the Patreon. I'm going to be doing exclusive videos and answering your questions. So that's all for this time. I'll see you in the next one.